Welcome back to the Orbit. Today we're going to do a bit of a deep dive into 0 DTE and other short duration trading, particularly looking at SPX and then comparing it to ETF, short duration ETF trading. This is something clearly in the zeitgeist. There is a lot of option volume on very short duration trading. And we're going to cover just what those traders are doing, what they're looking at on a day-to-day basis, why they keep returning to this space. There's a lot of talk in the media about this. Is it putting the market at risk? Is it putting these traders at risk? Is this a gambling mindset versus an investing mindset? How different is it from the rest of the options space? We're going to dive into that a little bit deeper here. But first, let's just talk about what we mean when we say 0 DTE. What we are looking at right now is a 1-week chart of the SPX. And we are using Options AI, which illustrates this in a very intuitive way. So what we're looking at is the past week of the SPX move in history, and we're looking at the next week in expected moves in SPX. And what we're talking about when we say 0 DTE, we are about 2 hours from the close today, and we're looking at this expiration. Each one of these dots on Options AI represents the next expirations coming out. When you zoom out, you can see them all out for the next year. In this case, let's zoom in even further from the 1-week chart. Now we really see today's expected move, which is 0.2%. Again, there's under 2 hours left in this trading day. You can see that the tomorrow's close is about 0.5 percentage point. This is what options are pricing for the break even of movement up or low, higher or lower. In essence, this expected move tomorrow, this is where options buyers and sellers have met to determine what is a fair price for the at-the-money straddle. How much is the SPX going to move in the next couple of days? This is where they have reached consensus. Whether that's right or wrong remains to be seen, and that's what people are trading. So going to today's 0 DTE, we can zoom in and we can see where the current expected move is, which is about 49.50 to the upside and about 49.25 to the downside. We're about just under 49.40 on the SPX. So essentially, what traders are looking at each day is they're using this expected move. Sometimes they're using the expected move over a couple of days. They are looking at the levels in the SPX chart, and they're basically saying over the next couple of hours, what are the probabilities and what kind of odds can I get for positioning that the market either makes a move or doesn't make a move inside or beyond these certain levels. So let's start. A lot of the trading that happens in this space is credit spread trading. So let's look at a couple examples of that. First, we are down slightly. This is almost unchanged on the day. But if we zoom in here, we can see this expected move is up about towards the top of this candle, not even a half an hour ago. So if you were positioning and saying, all right, that was the top for the last few hours in the market, you would be looking to sell a credit spread up above here, a call credit spread, saying that I don't think that the SPX is going to return back to these levels within that time period. So let's go ahead and look at that. So we would be clicking bearish here, and we would be generating a credit call spread at that level. We're selecting today as the expiration. And instantly we see on this chart that you're risking a little over $400 to try to make $65 with a probability of profit of about 63%. Now this 63% probability of profit is based on the fact that for the market to return and go back and turn this trade into a loser has less than a 50% chance because the stock is currently lower. The stock can go lower into the close. It can even go a little higher into the close, and this would still be a max profit. Now, let's look at a neutral positioning where we are generating an iron condor. And this is, again, going to be using those expected move levels. And so we're selecting today. and we're generating an iron condor, again, this is a little bit, the break even is a little bit below this level we just described, and that's because the SPX is declining a little bit. You can see this big red candle lower. But this, of course, some traders would look at that and they would say, I actually want to position this more around where unchanged is on the day. And they could move it up, catch the top of this candle. They'd be, the expected move would be putting this trade at risk a little bit to the downside. But now, and we are risking about a little bit more than 300 to make a little bit less than 200. And what we are looking at here in particular is where our break-evens are, which is about 49.50 to the upside and at about 49.25, let's call it, to the downside. And we are looking at a short strike of 49.50 and a short strike of 49.30. We want SPX to close in between these two levels for max gain. If we go up into this green zone, we are going to make a partial profit on this trade if we held it into the close. And of course, into this red zone, we would have a partial loss, and up above here, a full loss, and down below here, a full loss. So now let's get into a little bit of why SPX. Why do traders gravitate in 0DTE towards SPX? Well, of course you can there's daily expirations on SPY and Qs. But the difference between SPX and, say, SPY, that this is a cash-settled instrument, meaning in that scenario that we just determined, if this is finishing in between at max gain, if this was a SPY trade, you might take this into expiry and have both of these close at max gain. There's no difference with SPX. Where it really makes a difference is when you're up near the strikes of your trade or down near the short strikes of your trade. Even if SPX were to have its final print through this short strike, you do not have to close this trade necessarily. It is just a cash settled trade. So for instance, if this finished at 49.52, it would be $2 in the money from your 49.50 short strike. That would be your profit and loss at the end of the day. So you would profit partially based upon that 49.52 print. In SPY, if the same thing occurred, you would actually be assigned stock if you held that into the close and it finished above your short strike. Or you would be trying to close that short strike or close the entire trade in SPY into the close. And to compound things, SPY and Q trade after the close. They trade for another 15 minutes. So the premium in SPX gets settled. It goes to zero at 4 Eastern. SPY and QQQ continue to trade after the close. And not only that, their premium doesn't even necessarily go to zero at 4:15 because a lot can happen even after 4:15. Those products continue to trade after the close. And if they make a move after hours, traders have a certain time period after the close that they can enter in a exercise notice for something that even finished out of the money at the close at 4 Eastern. So you could potentially be assigned on something that you thought was out of the money if there was a big move. In fact, we saw that a lot last week as we saw some big earnings reports where Meta stock moved big after the close and the Qs and the SPY moved big with them. And so you could have had something that you thought was $1.50 out of the money in SPY, and you might wake up the next morning to find you were assigned. So traders like that aspect about SPX is that the math is very simple and straightforward into the close at 4 p.m. There is no more premium left on the straddles after the bell. You do not have to actually close it, even if your short strike is in the money. And therefore, you can see the appeal just on that alone. Now, what are some of the negatives of trading SPX as opposed to, say, SPY? Well, the most obvious thing is this is about as inexpensive of a credit spread as you're going to find with this $300 risk or something. You're going to be in the hundreds of dollars of risk in SPX. And the reason for that is not necessarily because it's a $5,000 underlying. What's more important here is that the strike width, right? So if you're doing defined risk trades, you only have the choice of doing $5 wide spreads, right? In SPY, you can go $1 wide. They even have times when there's 50-cent increments in SPY and Q and things like that. Traders can do a SPY trade where they are risking $30 or $50. In SPX, that's a little bit more difficult because of these $5 widths. There are products like XSP, which is basically a mini version of SPX, where you can get those more narrow. Now, we've spoken so far about credit spreads, and that is a very popular version of 0DTE trading. There are a lot of retail traders out there that are basically taking in higher than 50% probability of profits to sell credits that something does not happen, that you do not see them move into the close. But what if you were actually thinking you wanted to trade directionally, you were a momentum trader? Here's a good example. We have this big red candle coming down. What if you wanted to position for this to reverse and for SPX to go back towards 49.50 or even above it into the close? The other interesting thing about cash settlement is if you were doing this trade in, say, SPY, and you had pin risk up above at your short strike, let's say we were doing a debit call spread. Well, let's do it right now and show you. If we were doing this in SPY, again, because it is not cash settled, this won't go to its full profit. Even if we were at or near this 49.50 strike or slightly above it, right? In this case, what we are doing is we are buying a $10 wide debit spread in SPX with a break even of 49.43 and a max profit level at 49.50. If SPX finishes up here at 49.49, we do not have to worry about this short strike. We don't have to go in and close this trade into the bell because it is just going to be what it is. So wherever the spot finishes, that is our profit in this case, or loss in this case if we're down here. In SPY, we were probably most likely closing that trade because we don't want to be exercising this without knowing that we are going to be assigned that with the stock well above this level. If this was the 495 strike in SPY, for instance. Whereas in SPX, we don't have to worry about that, or traders do not have to worry about that. So in this case, this trader, if we did this trade, would be risking 350 to make up to 650. They only have about an hour and a half for this to happen, but you don't need much of a move. We're looking at our break even right now. That is only a couple of points higher. Yes, of course, we still need the move, so it's going to be something that is going to happen less times than it does when we are selling credit spreads and positioning for the SPX not to move. But in this case, you don't need much of a move higher. And the benefit of this versus a traditional American exercised option, one that is not cash settled, is we can actually deploy a multi-leg spread here to lower our costs and get our break even closer to where the SPX is trading without a lot of the trade-offs of actually being short a strike. So if somebody was trading SPY with this short of a time frame, they might be very nervous about that second leg, the short leg, because that basically means that they probably can't take it into expiration if they are exactly right, if it moves right towards that short strike. Not being exercised this call and does not need this to automatically be assigned to have a flat position tomorrow. This will be cash settled. They will have no position regardless what happens into tomorrow.